Rajeev Thakkar joins us now. It's good to connect with you, Rajeev. I was looking at your term sheet. You've given fantastic returns in last 1 year, both in the category and also the schemes you manage. 20% plus is an outstanding return in last 1 year. So compliments on that. Let's start with your current market view, and then I'll get into specifics of what your positioning is. What is your current market view?
A short answer to the current market view is I don't have a clear view if we look at the index or the overall direction of the economy. And the simple reason for that is there are too many moving parts. So, for example, I do not know when the cyclicals will rebound. So, the most affected sectors of travel, hospitality, multiplexes, when those kind of people will revive. I don't have an answer to where the what will be the level of NPAs in the financial sector, when the GDP growth will bounce back. So that is a very difficult question to answer. What one can at best do in the current environment is go sector by sector, company by company, and figure out, is this sector having more or less clear visibility? Is the growth on track, or are they less affected as compared to the others? And one can do a bottom-up stock picking, but overall view is very difficult to form currently. So if you had asked me 6 months or 7 months back that we would have this kind of a pandemic and we would fall so much and rise so sharply, I would not have guessed this. So no reason why I should be able to guess the next 6 months as well.
Okay, so let's talk about your portfolio positioning. HDFC Bank is out. Interesting. HDFC Bank is out, but you've added a lot of platform companies, or if I may say, energy exchanges. You got India Energy Exchange there, MCX right up there. Any special reason why you've added exchanges or these platform companies? Because HDFC Bank, what you've sold or what you've exited, again, is a gold standard company.
Absolutely. So nothing against HDFC Bank. So we still own it, by the way. We have just reduced the weightage. It's no longer among the top holdings in our Indian basket. So we have reduced the overall weightage to the lending-based financial services companies like banks. Again, simply from the reason that we don't have clear visibility of what happens when the moratoriums come to an end, once the restructuring is done, how much of the loans will turn bad down the road. So that will continue to be an overhang in the 2 to 3 year time horizon. Longer term, of course, these are great businesses and they will in fact benefit from reduced competition for lending, and cost of funds for these people has also come down because of the lowering of interest rates. So longer term, I completely agree that these are great businesses. So HDFC Bank, nothing against it, just that on the management side as well, it's undergoing a transition currently. And plus there is this overhang of COVID. So we are acting a bit cautious on that front. Coming to the exchanges and the platform businesses. So these are near monopolies in their area of operation. And in these kind of businesses, the first mover advantage is very, very strong. So, for example, National Stock Exchange was the first mover in derivatives, and BSE could not catch up later for many, many years, and even today is a distant number 2. So, IEX is the dominant player in the energy exchange, MCX dominates in the commodity market, and each of these spaces is interesting. So it's not that near term anything spectacular could happen, but longer term, given that alternative investment vehicles could see some participation in the commodity market, or mutual funds could come out with participation in the commodity market, industries could use it for hedging, speculators anyway are there. So longer term, you could see volume growth and profit growth in something like a MCX. IEX again, given that renewable energy is going to be a bigger piece of the overall energy pie in the coming years, that's the trend. So renewable energy is intermittent because sun does not shine all the time, or wind is unpredictable. So again, large consumers could directly buy power on the exchanges and just pay a wheeling charge. So again, these are potential developments down the road. Nothing is certain in any of this aspect. Of course, regulations will have a role to play, and one has to see how market develops. But these are very niche businesses with more potential, and again, they are not vulnerable to COVID, or they are not vulnerable to increased NPA cycles and things like that. So that's the reason to buy these.
The top holding of the scheme which you manage, at least the India holding, is ITC, deep value. By any stretch of imagination, a company which throws that much of cash should not be trading at this kind of an P multiple. But then there is an angle of ESG. Then there are concerns that what is happening to the cigarette business, which is contracting. The FMCG business on this kind of a turnover is not generating the profitability what other FMCG companies are generating. Aren't those obvious concerns which explain that the stock is depressed and could remain depressed?
Sure. So all of these are very valid concerns. And another pain point for investors is that people who have bought it 3 to 5 years back have seen negative returns, and that is, in fact, paining a lot of people. So obviously, the cigarette is a demerit good in the eyes of society and government, which brings in punitive rates of taxation. The volume growth hasn't come in 2 or 3 decades, meaning either the consumption is flattish or marginally declining. So that obviously is a negative in terms of the longer term prospects. But at the same time, one has to recognize 2 or 3 things which caused us to increase the stake in the recent months, and it entered the portfolio in March of 2020. So firstly, the long-term underperformance has increased the attractiveness from the valuation point of view. And we have seen this kind of cycle play out in many leading companies. So market memory is short, but if you go back in time and look at a company like Hindustan Unilever or a Nestle, they also have had periods of 5 years and 10 years where the stock did nothing or underperformed the market significantly. So the period from 2003 to 2007, one of the strongest bull markets in India, lever was a big underperformer in that market. So when there is a big underperformance, valuation becomes attractive. So that is point number one. Again, one of the biggest concerns of investors has been the capital allocation policy of ITC, where a lot of the cash flow was going into low ROCE businesses like hotels. That has clearly been stated by the management that they will complete the existing projects, but they are not going to start new hotel projects or deploy more capital into low ROCE businesses. So the capital allocation policy clearly has been improved in the recent times. The other factor is that the investments in the new FMCG category has had a long period of gestation, and we are now coming out of the gestation. So earlier, today the question is, these are low margin businesses. Earlier the question was, these are loss making businesses. So in any business, there is a upfronted fixed expenditure. There's a lot of expenditure on advertising and brand building, and it takes a while for the product to get market acceptance. So by now, I think we are at that stage where product acceptance is coming in, and that is becoming a bigger piece of the pie. And someday there will be a situation where you could see ITC as a more of a FMCG play rather than a pure cigarette play. Cigarette, of course, will be there for many years to come, but the current lens that investors view ITC with, which is only a cigarette business, that could change down the road. And on ESG, it's not black and white. So if you look at ITC's annual report, or if you look at the ESG ratings of independent agency like Morningstar or any other agency, they evaluate it on various parameters. So ITC, for example, is doing very, very good on the on purchasing renewable energy for their energy needs, or being carbon neutral, or not consuming water, and things like that. Cigarette, of course, is uh, anti-society or harming the consumer kind of product, but their other businesses, agri or the new FMCGs, are not. So one has to, there are shades of gray. Obviously, some people will not buy it because of their cigarette business, but it's a well-governed company in terms of the corporate governance. Environmental impact is not there, but in terms of adding carbon, etc., they harm the consumers. So that's a negative on the S front, the societal impact front. So on balance, I think in the current environment where the traditional BFSIs have this cloud of uncertainty, FMCG play, which is at very attractive valuations, in our view, deserves a place in the portfolio.
I guess we have to talk about IT as well, Rajeev. Morning. So let me get your perspective. Would you continue to increase the weightage of IT? It's already such a large chunk of the portfolio, but given the kind of momentum we've been seeing and the kind of outlook that we've been hearing from the IT majors, and I don't know whether to also throw in overall global tech, because I know you're quite positive on that, but would you continue to increase it vis-a-vis some of the other pockets like a banking, which still is also quite substantial when it comes to the exposure you have?
So we have actually not been adding significantly in terms of number of shares to the Indian IT companies. So the weightage increase in companies like Persistent and Infosys, etc., in our portfolio has gone up because of the price outperformance rather than our buying more shares from the open market. So the weightage is purely a function of the market prices. About global tech, so while everything gets classified as tech, but actually they are meeting different needs of consumers. So one can call Amazon a tech company, or one can call it a retailing company. In fact, the global pandemic actually has been something like made to order for these companies, because the pre-existing trends have got accelerated in the pandemic. So the shift from physical stores to e-commerce, shift from on-premise computing to cloud computing, linear television to streaming, print and outdoor media to digital advertising. So all the work from home and consequent impact on companies like Microsoft. So all the trends, in fact, have accelerated the business for these companies. So while stock prices have gone up somewhat sharply, but the business has also increased. So we are staying invested in that space as well.
All right. I do want to quickly ask you, I know we're a little out of time, but Rajeev, why you're not increasing exposure to Indian IT then?
So it's just for context. So the share prices of some of these companies have doubled from March. So even by not doing anything, the weightage has gone up very significantly in these companies. So we added quite a bit in March and April. So we added a new company as well in terms of Oracle Financial Services Software, and we added to our existing positions of Persistent and Infosys, and even the global companies. So the price increase has been very, very sharp, which has, in fact, the latest fact sheet actually has Persistent as the top holding. So even without adding shares, the weightage has gone up.
Rajeev, great to have you on the show. I would have liked to ask you why not why Persistent and why not any other of the IT names, but we'll leave it for the next time. Good speaking with you.
Thank you so much.